With global trade and geopolitics more volatile and uncertain this year than it has been for quite a long time, South Africa risks missing the opportunity that is taking place in terms of the shifting of global trade flows, as well as the reshoring or nearshoring of supply chains and value chains from the US and the EU away from countries and places such as Southeast Asia, possibly towards those destinations themselves, but arguably should be towards sub-Saharan Africa for the longer term. Now, amidst the US-generated global trade turmoil, Chinese President Xi Jinping announced recently that, quote, zero tariff treatment for 100% tariff lines, end quote, would be accorded to all 53 African nations that have diplomatic ties with China. This effectively means that this will provide those African countries with tariff-free access to Chinese markets, much along the lines of the duty-free access to the US market, which the Africa Growth and Opportunity Act, or AGOA, offers to 32 African countries for over 1,800 products. The current iteration of AGOA is set to expire in September of this year, and few signs exist that it will be renewed. African governments will be especially interested in new tariff-free trade agreements. Many African countries will be additionally incentivized to seek trade with China because they face high reciprocal US tariffs that were announced earlier this year. Those tariffs are set to be reactivated on the 9th of July. From that date, South Africa specifically faces a 31% tariff rate on its exports to the US. Now, we should be clear, China is not pursuing this trade option for purely altruistic reasons. It is seeking to increase its trade with countries around the world to help alleviate some of its ongoing domestic growth headaches, to secure access to raw materials, and to increase Chinese soft power at a time when many countries feel the US is generating geopolitical shocks and uncertainty. Through late 2024 and into 2025, the Chinese government has worked to portray itself as the defender of a rules-based global system advocating for free trade. In November of last year, Chinese President Xi Jinping said, quote, "We should tear down the walls impeding the flow of trade, investment, technology, and services, uphold stable and smooth industrial and supply chains, and promote economic circulation in the region and the world." However, whether a tariff-free agreement with China is meaningful for South African exports hinges on the details. While China is South Africa's top export trading partner, this trade has been composed mostly of raw materials and commodities. This is also true for many other African countries. While these countries are anxious to export other products, they face significant non-tariff trade barriers when it comes to exporting agricultural products into China, and are generally uncompetitive with Chinese industry when it comes to manufactured products. South Africa's trade with the European Union and the US is relatively more diversified, with manufactured and value-added exports better represented than in the trading relationship with China. Should South Africa choose to take advantage of tariff-free export to China, it will not mean much of a domestic manufacturing and industrial benefit if trade continues mostly along raw material lines. Any new trading agreement, while very much welcome, will not cure South Africa's domestic trade infrastructure and policy impediments and failures. Reform of the country's ports and railway network, as well as a steady move away from protectionist and subsidies-first trade policy, will ensure a more conducive domestic manufacturing environment and allow South Africa to be less dependent on and desperate for the beneficence of larger countries. Just a side note here, a national shipping carrier, as recently floated again by various government representatives, is not the answer to South Africa's persistent trade infrastructure problems. In one of our earlier macro reviews published in May of this year, entitled "South Africa Faces the Ultimate Trade Test," we found that, quote, "Such a large injection of global trade volatility presents an opportunity for South Africa to objectively assess its trade and investment policies. The country's potential role in acting as a major integrator of the Africa Continental Free Trade Area also plays in its favor. However, to take advantage of any such shifts and opportunities, South Africa's trade infrastructure, including functional ports, railways, border posts, and roads, must be fixed and modernized. The question remains, is Transnet moving with sufficient speed at reforming its expenditure priorities towards infrastructure maintenance and upgrades and away from ever more consumption, i.e. salaries? Does the now settled-in board continue to enjoy support from government? And is there sufficient political will to shake up vested government, business and labour interests so that South Africa's logistics policy space is actually changed? Transnet's monopoly on railways has served as a significant cap on South Africa's trade and growth potential. Writing in Business Day, Lawrence Edwards, Matthew Stern, and Jing Chien find that, quote, since the year 2000, export growth has slowed, and by 2022, export volumes were only 5.7% higher than in 2008, end quote. On trade policy, South Africa's localization master plans and other forms of protectionism, including never-ending subsidies shielding local industry from market forces, should also be reconsidered and revised. If South Africa could build and earn an international reputation for having reliable, safe domestic trade infrastructure, the country would benefit over the longer term from the various changes to global trade that are taking place in 2025 and will likely continue to take place for the next 4 to 5 years. However, should the government of national unity dither on necessary logistics reforms, this exceedingly rare opportunity in global trade will pass South Africa by. Thanks very much for watching. If you haven't yet, before you leave, a reminder please to like this video. Also, if you haven't yet subscribed to our YouTube channel, we invite you to do so. Just click on the subscribe button. Until next time, this has been Chris Hattingh for the Center for Risk Analysis. Take care.